Hello everyone and welcome to the first episode of Stock Market Lessons. This is going to be a series where I teach specific things about the stock market that people might have questions regarding, so that way you get a little bit more knowledgeable about certain things. Today's episode is going to be a pretty easy one. What is a PE ratio? So PE ratio, or a price to earnings ratio, is the ratio for valuing a company that measures its current share price relative to its per share earnings, or EPS. So basically this will be the price of a stock currently divided by the earnings per share annualized, and that way you can see that value. So PE ratio, I would say, is one of the most important metrics when you're actually looking at a stock on whether or not it's time to buy or not. Obviously there are other factors, but I think PE ratio is very good at determining fair value for a stock, and it's something that everyone should be aware of. So then when we're talking about PE ratio, we also have a forward PE ratio, and that's something we need to consider as well. So that forward PE ratio is going to be using the estimated earnings per share in the future rather than the current earnings per share. So this way you can see, based off the future of the company, if it's a growing company, that earnings per share, the forward price to earnings ratio is going to be a little bit lower than the current one. If it's a company that's slowing down growth, that forward price to earnings ratio is going to be higher, and you might be able to see that maybe the stock isn't necessarily going to be worth that value in the future. Now earnings per share and PE ratio don't typically decide 100% what share price is going to be. It all depends on buying and selling in the market, but it can be a good indicator in terms of what's fair value for a stock. Obviously fair value is hard to determine, but we'll get into that for sure. Right here we're going to talk about what a good PE ratio is. So if we're looking on the average on a long-term basis of the S&P 500, an average PE ratio is somewhere around 15. That's going to be a 15 times multiple. So that earnings per share annualized multiplied by 15 is going to get you that stock price. And that's an average one. So whether or not that truly is what you find to be fair value, what you think is average, what is average here, I think is a relatively fair term to describe fair value for a stock at. So anything above that fair value of 15, I would say is going to be a little bit higher. Anything lower than that should be something that's undervalued. So something that should have room to grow. But anything higher, obviously overvalued, under is undervalued. Pretty easy. There, a couple examples here. I'm going to start with a very simple one. Company A has a share price of $25 right now, and their annualized earnings per share is going to be $1 per share. So we're going to divide that 25 by 1 and find out that this stock is trading at a 25 times multiple, or PE ratio. Is this stock fairly valued? If we're talking about historical fair value, I would say this is an overvalued stock, so that's something to consider. Another example here, Company B with a share price of $35 per share, and an annualized earnings per share of $2.50 per share. We're going to divide that 2.5 from the 35 of the share price to find out that the P ratio of this stock is going to be 14. It's a 14 times multiple. Is this fair value stock? I would say absolutely. I think this perfectly would be a very fair valued stock. Anywhere hovering around that 15 is definitely fair valued. I'd say anywhere between 10 and 15 is fair valued in my perspective, or 10 and 20 I should say. Anything within that 10 to 20 multiple range I think is perfectly fairly valued, and I think you need to consider that forward earnings per share as well there to consider fair valuation. So let's say Company A here might have an earnings per share or a PE ratio currently of 25, but if we look in the future, maybe that EPS is increased somewhere around, let's say, $2 per share. If you think about that, that's going to be now crazy, because the PE ratio, forward PE ratio, is going to be down to 12.5 instead. So if you look in the future, this might be a fairly valued stock if we're planning on growth. So forward PE ratio is something always to consider as well. Let's go onward here. I'm just going to give some modern examples of some extremes here and a fair valued stock in my opinion. So Macy's Corporation, we all know Macy's. I chose well-known companies so we all have an idea what we're talking about here. Obviously Macy's, you'll see them darn near in every mall you ever go to. If you still go to malls, I don't know, do people go to malls anymore? I don't know, but so Macy's current PE ratio, it's going to be $4 or 4.49. It's 4.49 multiple. Obviously, with stock value of $14.76. And they also have a forward PE ratio of 5.11. It's 5.11 multiple to their stock price. So, what does that mean for Macy's? In my opinion, this is a good indicator of the fact that PE ratio doesn't necessarily mean it doesn't necessarily correlate to stock price. It kind of all depends on what the market's feeling right now. So these like specialty retailers, clothing places, discount retailers, for the most part are at a point in the market where they're just absolutely getting hammered in terms of stock price. It doesn't necessarily mean declining earnings. Some companies are, but some companies are still killing it in terms of earnings, but it's just because as a whole the market's really looking down on these kind of stocks, and that's what's causing a decrease in the share price. So this is an example of where PE ratio doesn't necessarily correlate to what stock price is going to be, but absolutely Macy's is an undervalued company for the amount of business they're still doing. So obviously this is I'd say just due to market conditions, it's not a stock I would personally buy, but it's a stock that's been beat down pretty heavily, and I think there's room to grow here once the market changes their mind on these retailers. And it will certainly. I think we're just currently in a phase where most retailers are just getting beat down pretty hard by investors. So once that changes, maybe Macy's is a good thing to look at, as you can see by these numbers. Now I'm going to go to a company I find fairly valued. Facebook. Share price of $185.67 at this time, with a PE ratio currently of 31.4. It's a 31.4 multiple, and their forward PE ratio is 19.5. So I find this fairly valued due to the fact of that forward PE ratio. It's between my 10 and 20 multiple range, so I find it fair valued. And in terms of tech companies, Facebook is certainly, I mean, I hate to say undervalued, but if we're talking in terms of modern tech companies, Facebook is certainly undervalued compared to most, because a lot of them are trading at extremely high multiples, where Facebook's pretty moderate here. Obviously 31.4 is a little bit high, but that forward PE ratio just shows that the stock is certainly not overpriced. It's still high growth company, so I think any growth in share price is certainly warranted here, and I don't think it's absurd to say that Facebook's fairly valued and that there's plenty of room to grow. Now I have an example of one of the modern examples. We have plenty of them, but this is a very common one. Tesla, very popular stock right now for many reasons, with a share price of $225.61, and this has no current PE ratio, and a forward PE ratio of 58. So how is this possible exactly? So Tesla is one of these stocks, and there's a lot of them right now. They're companies that are losing money. They're negative earnings, so their earnings per share are negative. And when that happens, you can't really calculate a price to earnings. It could be negative, but people don't really care about negative price to earnings ratios. Normally we just consider it as no price to earnings, meaning they're an unprofitable company. So Tesla's losing money, and this is kind of the headline of a lot of stocks right now. There's a lot of companies out there that are trading at extremely high values that have nothing really to back it besides the chance of success in the future. So it's all speculation on a lot of these companies. And honestly, Tesla shot up super high 7 years ago, 6 7 years ago, somewhere around there. The past 5 years, Tesla has actually decreased in share value, so it's pretty much traded flat since then. They've been working on increasing their profitability, but they're still not posting profit, and that's why this PE ratio is where it is. But you can see based off the forward PE ratio that in the future they do plan, and it's estimated that they are going to start actually earning money and becoming profitable. Obviously, still with that forward PE ratio, you can see it's very highly and very overvalued. With 58, I mean, that's a crazy high PE ratio, forward PE ratio even too. So you can see at least that the company's planning on growing, but overall stock price is still super high. And Tesla's not a stock I would personally purchase. I don't usually mess around with companies that make negative earnings, just because you never know what the future of the company could be. They could go out of business. Tesla's obviously not a fear for me because Elon Musk has so many avenues for making money. But who knows, once other competitors get in the game and they start being profitable off the bat, where Tesla's struggling here, who says that Tesla's going to be the top player in autonomous driving or electric vehicles in the future? There's no guarantee of that. Once around 2022, 2021 maybe, once those other companies actually start having viable models that they're releasing, I don't have no guarantee whether or not Tesla will be around, but overall you can see this calculation of PE ratios. It's all I have for you today in terms of this, so I hope you enjoyed this lesson. If you have any questions, let me know. Obviously I can go more in depth on certain things, but this is going to be episode 1 of Stock Market Lessons. So I hope you enjoyed. I'll see you next time.